Welcome back, students, to our final lab, actually. And this time, what we're going to do is we're going to put into practice a possible or backtest a possible investment strategy using ROC8 and earnings yield ratios. Now, we're going to use the data that we made in Lab 5. So I told you guys before, save it. We're going to run it. We're going to use it. And there's so many different ways we can try to make investment strategies over the data we're using. And even though it's just two ratios, there's so many avenues we can take. I'm just going to go ahead and take a simple avenue just to test it out. It may not make sense from an economic or financial point of view, but I mean, it's still valid. It's still a valid strategy we want to backtest, right? So for example, today what I want to do is I'm going to use the data from 2015 and 2016 to basically uh, find certain returns at certain levels, right? For those four trading cycles, 3-day, 5-day, 20-day, and 60-day. And basically what I want to do is I want to see that historically in 2015 and 2016, and you can take it even more data if you wanted to. I'm just doing this to make it easy on people with smaller computers. And what we want to basically do is look at 2015 and 2016 and say to ourselves, okay, for each of these four trading cycles, right? What was the levels for the earnings yield and ROC 8 that gave the best 3-day results, 5-day results, or let me say, put it another way, that gave the best or the most positive 3-day returns, most positive 5-day returns, 20-day returns, and 60-day returns. All right. I want to see that if there's a certain pattern that arises for ROC8 and earnings yield in respect to those time frames in terms of returns. Now, right off the bat, this is not going to work. It's too broad. Right, we're looking at 4,000 different stocks. I already showed you in Lab 5 how earnings yield plays by a different game. Just earnings yield plays by a different game depending on this type of stock, right? So, you know, I mean, there requires more of a nuanced approach to this analysis. But nevertheless, I want to do a broad-based analysis because it's cool. And once you do it once, you can always go back and tweak it and take a subset of data. All right, so I have a few rules in terms of when I go back and back test my model for 2015, 2016, or when I analyze the data in 2015, 2016. First off, I'm only interested in returns that were greater than 5%. All right, I'm a greedy person. I only want to look at scenarios where the returns were greater than 5%. Also, equally being greedy, I'm risk averse, meaning I want a strategy that has twice as many, in this case, twice as many greater than 5% returns rather than negative ones. I'm looking at ROC8 levels in increments of 10%. So 0 to 10, 10 to 20, like these ranges, right? I could have made it more fine-tuned if I wanted, but I did it in 10%. You guys can, by all means, please mess around with this. And I'm looking at earning yield levels in increments of 1%, right? By this increment stuff, basically I'm saying, okay, you know, what range am I looking at? I want to look at ROC ranges from 0 to 10, 10 to 20, 20 to 30. What earnings yield ranges am I looking at? Am I looking from 0 to 1, 1 to 2, 2 to 3, et cetera, et cetera? That's basically what I'm saying. So my ranges are pretty broad. I mean, we could fine-tune them even more, have more specificity, and that's fine. I give you more power to it. So first things first, I'm going to load up my daily price from my Lab 5. I'm going to go ahead and load that sucker up. There's my daily 5. Let me just get rid of that 5 part. Give it a moment. This will take a little, so reading it out takes a little time. It's fast, but reading it in, it takes a little bit of time. All right, so there are 9.8 million rows. And you can confirm that this is indeed the file that we used last time by looking at the columns. I have my return 3, 5, 20, 60. I have my RC8. I have my earnings yield. All right, so I'm good to go. I got all this. I did all my work before. I'm ready to rock. Now, before I move any further, go ahead and remember to run your data table. All right, I think that's the only one we need for today's lab. Let me save this. Oh, no, that's not. It's lab 6. All right. All right, so from here, let me make this slightly bigger so you guys can see. All right, so from here, I'm going to take a subset of daily price. Why am I going to take a subset of daily price? Because I want to go back. If you remember from Lab 5, we left off with the fact that, hey, you know what? I only want to look at stocks with price targets greater than or equal to $5. This is going to affect our analysis. I only want ROC8 greater than 0 and less than 2. This will affect our analysis. And I only want earnings yields greater than 0.05 and greater, less than or equal to 0.05 and greater than 0. All right? And obviously, I just want 2015, 2016, 2017. This is all going to affect, these ranges I put right here are going to affect our analysis. Again, you have full control of what you want to do, right? I'm just doing this. These are the assumptions I'm making, right? But the sky's the limit. Let me fix the quote over here. Let me roll over here, press, see if I can scroll over. Okay, perfect. Excellent. So when I do this, I now have a table DF6. And ladies and gentlemen, I don't need daily price anymore. I can remove it. And for those of you that have machine memory issues, go ahead. We got the data we wanted. Execute that, and you notice daily price was gone. You just freed up some memory. We still have about 1 million rows, but this is much more, this is like 1/9 of what you're dealing with, so this should be much easier to deal with at this point. All right. Now, I will create 4 new columns, RB3, RB5, RB20, RB60, right? What are they going to be? They're going to be basically scores. They're going to be scores for me. All right. Why do I need these scores? Because remember from before, I said I'm greedy. I want to find ranges where in 2015 and 2016, there were twice as many returns that were greater than or equal to 5% than there were ones that were less than 0. So what I'm going to do is, for each one of these columns, right, I'm going to look at their returns. Let's take the first one, their 3-day return, right? If the 3-day return was, I'm going to go through my data. If the 3-day return is greater than 5%, I'm going to give that score 1. If the 3-day return is between 5 to 0%, I'm going to give 0, right? I'm not going to give it a 1, but I'm not going to let it penalize me anyway, either, okay? If the return, 3-day return is less than 0, I'm going to give it -2. Why? Well, the logic here is that if I get a total score of 0, that means that for every 1 day of a negative return, a negative 3-day return, I got 2 days of positive 5%, at least 5% returns. So that 0 cumulative 0 score would basically signal to me, oh, I'm going to get 2 for 1 over here. 2 positive 5% returns for every 1 negative day return. And that's what I'm looking for in my ratios. That's what I'm looking for in my ratios. All right? So let me go ahead and do that. Copy this. All right, go ahead and fix the quotes again. One of these days I will figure out how to have the right quotes in my PDF file. Run this. So right back, I create 4 columns, RB3, RB5, RB20, RB60. They're by default 0. And now here the values will change. If it's RB3, it's going to go through the data. If return 3 is greater than or equal to 0.05, 5%, right? It's going to get a 1. Same thing with RB5, RB20, RB60, right? It's literally going through those columns and changing those points in time in 2015 and 2016. And also it's happening in my 2017 because my 2017 data is in there too, but that's okay. It's changing them all to 1s, right? And same way, those will be the 1s. What about my negative 2s? Now I'm going to go and change the filter for any situation where the returns were less than 0 and make those values negative 2. Less than 0. And I'll copy and paste this. Alrighty. Okay. Now we got, did I even run this? I forgot if I ran this. Boom. Done. Okay. Now I need to create my groupings for ROC8 and earnings yield. All right. I need to create my groupings for ROC8 and earnings yield. All right. Remember, again, I am looking at tight ranges. I'm looking for ranges of ROC8. I'm trying to identify a range of ROC8 and a range for earnings yield that I want to use to pick my stocks as a strategy, right? The question is, what's the right ROC8 and earnings yield ratios, values that I should look at when buying stocks? Well, that's what we're basically trying to figure out here, right? So the ranges, like I said before, for ROC8, I'm going to create another column called ROCG for groups. And that's going to go ahead and create the groupings for me. And the groupings will literally be given the labels numbers. They'll be given numbers. I'm going to use this funky little function right here called cut. That is an awesome function that's going to do the work for us. All right, it's going to do the work for us. All right, so what does cut basically do? Well, cut basically takes 3 parameters. All right, cut basically takes 3 parameters. If I can show you an example, let me show you a simple example. I got A equals, I'm going to create some sample numbers here from 10. All right. So I'm using a random number, so your numbers are going to be different. So let's say I'm using sample. Sample is a random number generator. So let's say I have the numbers 5, 6, 2, 9, 4. Okay? And let's say I want to create 5 groups. Let's say I want to create 3 groups, right? The first group being from any number from 1, 2, and 3. The second group is 4, 5, and 6. The third group is 7, 8, and 9. Okay? So let's do temp. All right. So I have this temp database right now, the table right here. Okay? And I want to put these numbers in groups because I want to group these numbers together, right? And I want the group to be dictated by the value. So how am I going to do this? Well, I'm going to use a cut. I'm going to go ahead and use the cut function. And basically what the cut function does is it says, all right, which group of numbers do you want to break into groups? Well, in my example right here, it's going to be A. That's the first parameter. The second parameter right here is basically what's the ranges you want to give? All right, what's the ranges you want to give? Well, I want to give from 0 to 3. And the reason I say it's from 0 to 3, from 3 to, let's see, 3, what did I say? 1, 2, 3, 4, 5, 6, and 7, 8, 9. Okay? All right, now I gave this vector. Breaks, in the breaks parameter, you give a vector of numbers. And that vector of numbers is your intervals. So how does this transform into intervals? Very simple. This will be from 0 to 3, where the lower number is exclusive and the higher number is inclusive. So if there's a 0 value, it will not go in the first group. But the first group will be from, basically the first group will be from 1 to 3. The second group will be from 3 to 6. Again, the lower number is exclusive. So it literally will actually mean 4 to 6. The third group will be from 6 to 9. Again, that lower number is exclusive. So literally it'll be 7 to 9. Okay? The third, and so that's basically what's given to breaks. A breaks is you give it a vector of numbers, and from that vector of numbers, it dictates the ranges you want. The third parameter is really easy. It's the labels you want to give each group. You can name this group anything you want. Apple, banana, cherry. In our cases, we want to keep it simple. So we just give it a false. And when it's given a false, the name of the group is just going to be integers. So when I run this, right? Oops, I didn't save it. Let me save this as a, I'll save it as a B equals. So when I run this, we actually saw the results. And I run temp dt, look what happens, all right? So where does A fall into? A falls into, where does 5 fall into? It's 5 is between 4, 5, and 6, right? That's the second group. Where does 6 fall into? 4, 5, and 6, that's the second group. Where does 2 fall into? 1, 2, 3, that's the first group. Where's 9? 7, 8, 9, that's the third group. Where's 4? 4, 5, 6. 4, 5, 6, that's the second group. Okay, that's the second group. Notice again, 3 to 6, that 3 was silent. That's why 4, 5, the 4 is in the second group. Oh, I didn't pick anything that was on the border, unfortunately. Oh, there we go. The 6. See how the 6? See how the 6 falls in the second group and not the third? That's because the range for 6 to 9, 6 is the lower number, that is exclusive. But here, from 3 to 6, 6 is the bigger number, that is inclusive. And that's why the 6 goes in the second group. So this is how we can create different groups. And this is how we can create different ranges for any ratio we're dealing with. So we go back here, right? Now, obviously, I'm going to create a new column that's going to put the ROC8 values into certain buckets or certain groups, depending on its value. So the buckets are defined by this array I give it. What array am I giving it, people? I'm using a sequence function. What am I giving it? If I just run this part right here, I'm literally giving 0 to 10%, 10 to 20%, 20 to 30%, 30 to 40%, et cetera, 190% to 200%, et cetera. Remember, the smaller number is always the exclusive one, the bigger number is always the inclusive one. And the labels are false. So when I run this, okay, I now have ROCG grouping, right? And we can see those values if I run the table command, right? If I run the table command and just the ROCG column, this will give you all the, right here. Let me just call this so nobody gets confused. Cut example. All right, so if I want to see a summary of the way the groupings were broken out, if I just do df6 $ROCG and run it, and now you see the summaries right here. See it? So there are 150,000, 155 ROC8s that fell within the range of basically greater than 0 and less than 10% ROC ratio. That makes sense, right? But you know what's surprising here is there's actually more. The most predominant amount of ROC8 values were actually greater than 10% and less than equal to 20% right here. That's the biggest number, it looks like. And the smallest range, no surprise there, is for the ROC8 values that were from greater than 190%, but less than 200%, less than equal to 200%, 7,986. That's shocking. There are a lot of them, but again, we could at this point wanted to explore some of these. We can dive deeper and just say, okay, for a certain level, show me these ratios. Let's graph those, get an idea which tickers they are and what's going on there. But we can also, so you, again, that's technically the way you should be doing it, right? You should be getting more and more nuance and detail as much as possible as a quantitative researcher. But we'll just go ahead and muscle on through for this strategy, just for your learning experience. All right, so I got my ROCG. I got my groups for my ROC. Now what about my groups for my earnings yield? Let's go ahead and do that. Okay, so I'll do the same thing here. I'm going to explicitly choose the breaks for earnings yield because there's not that many. But again, if you wanted to make many, that's fine. You guys can do that too as you're following along. So here I'm creating a new column called EYG. The earnings yield, we're breaking that up, and these are the ranges we're giving: greater than 0, less than equal to 1%, greater than 1%, less than equal to 2%, et cetera, et cetera, et cetera. I run this. Let's do the table command on this bad boy. df6 $EYG. And okay, looky. Let's see what we got here. All right. Again, the largest amount of earnings yield ratios was in the second group, and the second group is what? Greater than 1%, less than equal to 2%. So that turns out to be the most popular level of the earnings yield, which is funky, and this is pretty cool. And again, we're seeing this for, this is actually, we're analyzing this not just for 2015 and 2016, but we're looking at both, all three, 2015, 2016, and 2017 here. All right, the summary. But it's interesting, very interesting. From here, right, we're now going to go ahead and calculate our cumulative scores. All right, we're going to now calculate our cumulative scores. Now again, I am now going to take the summation. I'm going to look what's going on here. I'm doing a buy over here. All right, see how everything's coming together from all those previous weeks? I'm saying, listen, create a subtable for every group of ROCG and every group of EYG. Right? This is going to create how many groups, guys? Subgroups? I have 20 groups of ROCG, 5 groups of EYG. This is going to give me, that's right, 100 subgroups. 100 subgroups. All right? Within each one of those subgroups, I'm going to add up those RB3, RB5, RB20 scores. Right? And I just want to see cumulative those scores if there's anything that's 0 or greater than that. Because that tells me that historically, in this case, notice I'm applying the date filter here. I'm applying the date filter here because I want to use the results from 2015 and 2016 to trade in 2017. So that's why I'm not using 2017. I want to use the scores from 2015, 2016 to trade in 2017. Right? I want to see if there's any kind of relevance there. So when it sums it up from 2015 and 2016, let's take the first grouping pairing. Let's take the first grouping. So ROCG, we're looking at a scenario where the ROC8 is less than 10%, right? Less than is greater than 0, but less than equal to 10%. Okay, so all the stocks that were at that moment in time in 2015 and 2016, in that moment in time, anywhere in 2015 and 2016, when they had an ROC8 that was less than equal to 10% but greater than 0, and an earnings yield that was greater than 0 but less than equal to 1%, right? I'm taking all those stocks at that moment in time in those 2 years, and I'm calculating. I want to sum up. I want to basically sum up their signals for what their 3-day return was. If their 3-day return, again, like we said before, if it was greater than 5%, greater than equal to 5%, I'm going to give that a 1. Anything that was between 0 and 5%, that was a 0. And anything that was negative was given a negative 2. And I'm adding up those RB3s, right? I'm adding up those scores. Let me copy and paste this. All right, so I go ahead, let me change the code here. I run this, I got DFRB3. Let's take a look at what's there. Boom. Again, you see how you get those 100 rows back? Why do we get the 100 rows back? You're getting a unique row for each combination. You're getting a unique row for each combination. Look, group 2, group 1, group 3, group 1, right? Now what I want is, I want to redo this ordering because I want a score in descending order. I want the greatest on top, the smallest on bottom. All right, and by the way, real quick, notice the column names. Because we grouped by these 2 columns, you're going to have those 2 columns right there. ROCG, EYG, and because we used a function over here, right, an aggregation function. This is going to be turned into V1 column, right, and that's the column that's the score. That's the column we're basically doing our ordering by. Okay, so here do my ordering. Now remember, when you use the order function, you want to do something in descending order because by default it goes into ascending order. We simply apply -1 before it. So if I do right here, just apply the -1 right there. I run, oh, that should be V3. I run this, and now let's check out my results. All the way up. Okay. Negative. So it looked like the best performing group was ROCG 11, earnings yield G5. So 5 for earnings yield G, that means the highest earnings yield. We're talking about greater than 4%, less than equal to 5%. Okay. Group 11, I think that falls under greater than 100% ROCG, less than 110, or greater than 100%, less than equal to 110%, I believe. We could always double check that. But we still got a negative number. You see, we got a negative number. If we had a 0 here, that is basically telling us that we had equal amount of days, we had equal amount of 3-day returns where there was a greater than equal to 5% gain as there was, I'm sorry, we had twice as many days where it was greater than equal to 5% as opposed to a loss, a negative return. We have a negative number here. Because we have a negative number here, that assumption, or that, I don't want to say assumption, but that point, or that requirement that I had, that I want twice as many positive 5% days versus negative days, is violated because it's negative. It's negative. Now look, it's still possible that, depending on the total amount, that there were more positive 5% returning days than there were lost days, but it wasn't 2 for 1. And because of that, I'm sorry, I'm going to have to pass. All right? So I'm going to pass on the 3-day. The 3-day is not going to work for me. 3-day is not going to work for me. So let me go ahead and jump to my 5-day return. So let me run this back now and do this for 5-day. All right. Again, all right, again, we got a scenario where it's a negative number. So again, I could have it could be it's a possibility that I look in the 5-day returns, there are more positive 5% return days and there were negative loss days, but it's not 2 for 1. It's not twice the amount. And I'm gonna have to pass. All right, so now let me look at my 20. RB20, guys. Let's see. Oh, RB20. Even 20 days. It's smaller. It's negative 27, right? I'm sure I got more positives there, but again, it's not 2 for 1. Maybe I was too strict. So let's go to 60 days now. Oops. Boom. All right. Now we got some positives. Check this out. We actually got 4 to choose from, right? We got a nice, we don't even have 0, but we have actually positive numbers showing that our criteria was met and then some, all right? So we're left with these 4 values. Now the question is, which one should we take, right? Which one should we take? Now, in reality, these are absolute numbers, right? These numbers are driven by the amount of scenarios there were. Like, for example, I have a score of 138. That's great. But how many returns were there total that fall under that bucket, right? How many returns were there total that fall in that bucket, right? That 138 could be just a function of the fact that there were just so many more opportunities. There's so many more returns in when there was a ROCG at 10 and an earning yield group at 5, right? Versus the other point, like versus line 4 that only had a score of 18, right? So what I would want to do is I would want to basically get a percentage based on how many, what's the total number of trades there were? What's the total number of trades there were total, right? Total. But just for simplicity's sake, I'll just take the lazy way out, and I will just simply take the largest V1 score. So in that case, 138. So there you go. I'm going to take, I'm going to use that grouping. I'm going to use basically the range of ROC8 that's in the 10 grouping, and the earnings yield group, earnings yield range that's in the 5 grouping, which is again greater than 4%, less than equal to 5%, right? And 10, I believe, was greater than 90% and less than 100%. Greater than 90%, less than 100%. So that's the ROC8s I'm looking for. That's the earnings yield ratios I'm looking for. Let's go ahead and get to work, right? Let's go ahead and get to work. Basically, and also I want to point out, it was on the 60-day trading strategy that 60-day returns, we have more positivity. That actually kind of makes sense because, again, these particular models are using fundamental data, and fundamental data tends to work better on multi-quarter, possibly multi-year levels than on these 3-day, 5-day, 20-day scenarios. You're going to look, if you want to look at, first of all, if you want to look at models like that, the data they tend to use is not end-of-day pricing data. They tend to look at intraday tick-by-tick pricing data. That's number one. And the type of models they look at are different, looking at different fundamental values, different kind of ratios, right? Stuff that moves faster and is a little more volatile. So let's go ahead now. Now that we know what ratios we want, let's go ahead, 20, 60. Let's go ahead and run my results for 2017 and see how I did, see how my trading strategy did. My trading strategy is going to be very simple now, guys. I'm basically going to look for starting the 1st of 2017, look for scenarios where my earnings yield is greater than 0.4, less than equal to 5%, right, within that range, and an ROC8 score that's greater than 90% and less than 100%. And anytime chronologically in the year 2017, I find stocks with those scores, I'm going to buy them. All right, I'm going to buy them. And when I buy them, I hold those bad boys for 60 days. All right, I hold them for 60 days, and then I rebalance my portfolio. And that's how I'm going to basically do my strategy. That's basically how I'm going to do my strategy. So I'm going to take another subset from DF6 just for my 2017 strategy. I'll call it DF Lab 6. Scroll over a little bit. There's my parameters. I'm strictly taking 2017 data now. There's my filters based on my back testing of those ratios. Create DF Lab 6, right? We can look at it and start trading. Let's put it in order, right? We want it in order, obviously chronological order. DF Lab 6. We'll put it in date order, and that's about it. We'll just put it in date order. All right. We don't have to even, the tickers don't even have to be put in proper order. So I go ahead and run this. And now we need to do one more thing before we can go ahead and do a little strategy. Okay. So what we need to do is we need to, I just pretty much changed at the bottom over here. So what we need to do is we need to now change the, this is going to get a little funky. I need to get the rebalancing date for each one of my trade days, possible trade days, right? Because remember, these are 60-day strategies. If I trade on the 1st of 2017, I don't want to trade again until after the 60 days because we're looking at 60-day returns. These are hard rebalancing dates, right? In actuality, we don't have hard numbers like that. That we use, again, technically we should be using earnings yield to tell us when we should trade in and out, but that's, again, that's a total, we could, that's a tweak you could make in this model, but we're just keeping it simple, right? We're saying, all right, there's a hard stop at 60 days. So I need a rebalancing date. How am I going to get the rebalancing date? All right, I'm just going to simply create another table called data DT, date DT, that just has all the dates, trading dates for 2017, right? Actually, I should make this greater than equal 2017, all right? And so I'm filtering the F6 just for the dates right here. Anything that's, should be greater than equal, I'll make that change. And I'm basically taking the unique, I'm applying the unique function to the date column, because I don't want all the dates, I just want the unique dates. And notice I put a dot parenthesis there because I want the result back not as a vector but as a data table. I want it as a data table because I'm going to do a VLOOKUP with it, right? And once I get that table, I'm going to put it in order. So let's do the first part right here. Make that greater than equal, right? Apply the unique function, and this is what I mean by what I'm talking about, right? So let's go ahead and just, if I just did this, right, date, right, first of all, it's not a data table, it's a whole bunch of vectors. Second of all, notice it's more than, it's 369,000 rows of dates. In a year of 2017, there's nothing more than 365 dates, right? Why are we getting all these dates back? Because it's giving us the dates for every column. I mean, for every row. Every row. Remember, there's multiple tickers here. It's giving you the date for every ticker throughout the day, for every day. We just want the unique ones. This is why we apply the unique function right here. And then I run it, right? And I run date t again down here. And you notice again, okay, cool. Now I have the right amount of dates, right? But you see, it's a simple vector. It's not a data table. It's not until I do the dot parentheses, see that? I think this is practice set 3 coming back at you. Dot parentheses. Then when I run this now, I get my results back as a data table. See that? And it looks like everything's in chronological order. I don't have to put in the proper order. All right, looks like I'm good there. But if you want to, just for sakes, checks, we could put it in order just to make sure it's in proper order. From here, what do I want to find? I'm going to create a new column called our date. Notice the column, by the way, here is V1. V1, that's important. So now all I want to do is I want to find for each one of these dates, I want to find the date that is 60 days into the future. That's all. Just like we did with our returns, right? I just want to know what date I need to rebalance the bad boy. That's it, right? And when it gets later on, closer here, there's not going to be a future date. It's going to be like an NA, right? So that's basically telling us, okay, you're pretty much done trading for that year. You're done trading for the year at that point, based on this strategy. All right, so I'm going to basically do a shift right here, but I'm going to do a forward shift. You guys remember this? The forward shifts. The forward shifts, when we did calculate the returns, just use the extra parameter type equals lead to go ahead and shift it into the future. Fix my quote. So instead of looking backwards, it's going to look forward. Now obviously I have to use V1 because my data date, the name of the columns of the dates is V1. So I go ahead and run this. And I have a new column now called our date. And we know what this is. All right. This is the day, this is from this trading date. If I bought the stock on this date, this will be 60 days in the future. So after this date, I can look to buy again, right? I can look to buy again. So hypothetically, if I bought on this date, I couldn't buy on any of these other days, even if the criteria even if I meets the criteria, because I already purchased and I'm waiting for the 30-day return. The 60-day return. Now, all right, it's important to understand that there's a little discrepancy here because maybe you guys already noticed it. When we were back testing our ratios, we didn't make that stipulation, right? We didn't make that stipulation. I'm making that stipulation now, we don't have to follow it if we don't want to, right? In fact, I'll calculate the results for both of them right now. even though in my slides I was more strict about it. But when we back tested, we didn't look to see if we were following the same chronological order. All right, we just basically said, hey, I'm looking at the signal. Every time this signal hits, I'm buying and waiting to sell in 60 days, even if it's back to back to back to back days, right? So we could be more complicated and more strict, and technically we should be. We should be. It's just slightly more advanced doing that. So I don't want to hammer you guys too much on this last lab. I leave that up to you guys to fine tune that. All right. But here, I have from this table, I have my rebalance state, and all I'm going to do is I'm going to do basically a VLOOKUP with my lab 6 right here. You guys know how to do this. Again, I love the fact when everything we did in the past all comes together. All right, so basically I'm merging the dates, the R date dates from date DT to DF lab 6 to give me guidance on my trading strategy. Right, and obviously it's going to be joined on the date column from DF lab 6 and the V1 column on the date DT table. I run this, and now I can check out my DF lab 6, and we'll notice something very interesting. All right. Oh, actually, we don't want to run all the columns. We just want these columns. We just want the date, the R date, the return, and the ticker. I want to see how my strategy would have done. When we do this, right, all the rows. Actually, before we do that, let's do. There we go. There's only 6 rows that made the cut in 2017, guys. In 2017, there were only 6 rows. There's only 6 points in time, and just one ticker from each one of these dates that made the cut. And in actuality, it was just one ticker. It was just 2 tickers if you break it down. This one first, BKE, right? And this other one, URBN. Both are, first of all, let's look at what they are. So BKE, it's a retail company, Buckle Incorporated, right? It's a clothing company. Buckle. Do you guys know about it? I never heard about it. All right, I don't know. Maybe it's great. I don't know. Right? It's not my world. Not my wheelhouse. This stuff. All right. So the first one is Buckle. All right, cool. Maybe you guys are a fan of it. The other one that actually showed up a lot was Urban, and this is the Urban Outfitters. This I do know about. They own a whole bunch of stores, right? Urban Outfitters. They own, what do they own? They own. I think they own Anthropology. Yeah, this Anthropology. Okay, I only know Anthropology. I don't know about the other guys, right? So both of them are retail stores. Huh. Right? And that's actually so yeah, let's talk about that, right? So let's talk about that. So both of them are retail stores. Now, that is because that's the nature of the beast, right? That's the nature of the beast, right? Things change from time to time. The reality is in 2017, for whatever reason, these type of companies had these high levels of earnings yield, right? High levels of earnings yield. They're basically saying that maybe the price was really low because of retail, and also because of their ROC8s were high. But this could be a result, not much of the operating income, but more of the fact of how much capital allocation they gave, right? Maybe it just doesn't cost that much to be a retail company at this point in 2017. In fact, we know it doesn't. A lot of this stuff is offshore, right? They don't have production companies here. So these ratios sometimes, and their levels, as we knew from Lab 5, they, at a certain point in time, they kind of cheat and give us certain kind of companies. In this case, the returns were fantastic, right? Hypothetically, actually, I would have lost money here on BKE. I would have lost money on my first trade. And technically, I wouldn't have done my next trade till after August 4th, which would be right here. And here on Urban Outfitters, actually, I made money. So in terms of let's calculate my compound return. I'm not my compound return, my annual return. right? So if I invested, let's say do a return equals DF lab 6, and I want it basically for the first row and the fifth row, right? And I just want the ret 60, right? So that's all I want. I just want those two values. And so if you look at ret, it's right there, right? And so now I can do my 1 times 1 nonsense. So if I'll literally just do 1 plus ret, it gives me, you add 1 to it, then we multiply 1 plus ret, and then we subtract 1 from that, right? And for the year, guys, for the year, my return was 57%, which, by the way, is fantastic. I have no qualms there. 57% return is great. It's fantastic. But notice I had 1 loss and 1 positive. That's number 1. Second, notice I didn't have much trading opportunities, right? That's not necessarily a bad thing. That's not necessarily a good thing. Just as long as it makes coherent sense. For me, to trade retail, I don't feel comfortable doing that, even though it looks like they did give me some great returns, right? So I would look back into my ratios. I would look back to my ratios and see what's going on. The reality is, all right, there's only 2 moments in time I get, right? I think I was kind of strict with my strategy, and I would have to go back and reuse my strategy again, right? First of all, instead of just doing a hard case of 3 days, 5 days, 60 days, whatever, et cetera, what I would be looking at now is that I'm looking at a situation where what was earnings yield when we got high returns, right, in the future. So what I would want to do is I want to redo the analysis so that, and this is slightly more complex, right? This is why I didn't do it this round with you guys. I would say, all right, look at the ROC8, and based on certain levels of ROC8, let's buy the stock, right? And we would back test it like we did before. We could create different buckets. And then instead of looking at what the hard returns were, we would compare what the earnings yield at that moment we bought was. So we would actually have to look at earnings yield in the future as well. Right? We would have to look at when we bought it and when we sold it. Because the earnings yield, remember, is the signal. Earnings yield for us is the signal, right? Technically, that's what it's supposed to be used for. So that's one, right? 2, we have to look at what point in time we're at. 2017, right? There's a lot of companies making a lot of money. Where's the technology companies? Right? Where's the technology companies? Why didn't they show up? Technology companies look at Tesla again. Look at its earnings yield wasn't even positive, right? And Apple's was positive, but we know what its earnings yield and ROCs were. They were within certain ranges, right? Not these high ranges, right? Apple's earnings yield was like 2 to 4%, 2 to 4%, right? It didn't even make the cut to what our trading strategy is. So the point I'm trying to make is that technology, we have to understand the context of these ratios. These tech companies have major overhead. Apple probably has the least out of them because they're the original people that started building out in Foxconn, right? But they still have major overhead, these costs. And these costs affect these ratios. So we would have to actually fine-tune these ratios to find the companies we want, right? That are with the returns that we were looking for. Or we could keep the ratios as is and open our minds to new kinds of stocks. Like for me, maybe Urban Outfitters made sense to invest. I would have to look at a whole bunch of more ratios to do that, right? Look at a whole bunch more ratios to do that. But on a flip side, we left out a lot of data. What about all the prices of stocks that were fine, greater than $1, that were less than $5, maybe greater than $1, but they were less than $5? What about those stocks? There's still tremendous opportunity there, right? Why? Not necessarily the penny stocks. You want something with some sort of liquidity. Well, we call them small caps. Why? Because a lot of the big boys, minus the hedge funds play there, but minus the big pension investment funds, they can't touch those stocks because there's certain rules about market caps when they invest in certain stocks versus others. So those stocks are left in the wild, wild west, meaning that there's probably tremendous opportunity there that hasn't been realized yet, right? And obviously those stocks tend to also have ROC8s and earnings yields in the negative side. We saw that. But maybe we need to broaden our minds when we're doing that kind of investing. We definitely, right, need to check out more ratios. We just checked out 2 ratios over here. And we haven't even begun to run the stats, doing the statistical tests on just the basic scenario we just did right now to see that if this was just random or there's something there, right? It was just random or something there. In actuality, if we want a more robust test, we should actually go back in 2007 and rerun this year over year, year over year. Fine tune your ROC8 earnings yield levels, test the results in the next year. In that year, fine tune your results again, test the next year, and so on, so on, so on. If there's a steady pattern that comes out, maybe you've hit on something. Maybe you hit on something, right? And finally, we're talking about being quantitative researchers and being quantitative value investors. We're just looking at 2 ratios here, guys. 2 very fundamental ratios, first of all. Second of all, what about all those others, like over 100 other ratios? What about looking at those ratios and the combinations of those ratios? And those ratios are just on the fundamental data. What about alternative data? What about data that has like car inventory, like for Tesla, right? We can get inventory information for how many cars Tesla made, how many cars did they ship out, et cetera, how many cars they sold, leased, not just Tesla, all these companies, right? We can get inventory information and just go from there, alternative data. What about models on those alternative data? Now, sit back and understand there is so many, from quantitative point of view, there are just so many avenues you can take. And this is why, and now we can start talking about, okay, this is too much. Now let's talk about machine learning. Now let's talk about having the computer and these off-the-shelf machine learning algorithms crunch through these ratios and some of these scenarios and tell us what we should be focused on. Because it's way too much of a spectrum. Way too much, right? The ratios you use, the data you use, how you use them, how you apply them, your little trading schemes, right? And now you have an understanding of why these big hedge funds now, the smaller hedge funds are now gone, but the big hedge funds now, they look like these big startup IT shops with these massive servers, massive mainframes, right? What's really going on there? Well, they're just going through, they're constantly testing these ratios over and over again in different kind of scenarios and ones they haven't even thought about. And in fact, I was just listening to, recently I was listening to an interview with one of the guys that, I guess he was one of the pivotal founders of a very famous investment fund, the Medallion Fund from Renaissance Funds, right? It's very secretive. It's one of the most successful hedge funds, right? Best of the best PhDs around the world. And they talked about that their model sometimes creates signals from data that they're just looking at themselves like, how does this make sense in any sense? Like, how does this make any sense in the real world? But nevertheless, those signals of those weird data has made them tremendous amount of money, right? And that's really the game. So this is basically your first step. Hopefully you guys had fun with it. I strongly encourage you guys to go back, mess around with it, tweak it yourself, make it your own, something that makes common sense to you. I just try to do something here that's pretty broad and basic in the sense that you guys could follow and execute. But obviously, like even if we mix earnings yield into the mix, right, properly, this thing can get really complicated and messy. So at this point, you should be asking yourself, okay, look, did I enjoy this class? Well, there you have did I enjoy doing the stuff in this class, the data analytics? Maybe data analytics is not for you, right? Even though you should understand it and the programming aspects behind it, right? That's fine, because a lot of our students, they go into consulting anyway, and our students manage those projects or work on those projects, but they're not the people doing the analytics maybe or the programming behind the scenes, so that's fine. But they're still in it. Or you have to ask yourself, wow, I do not care about investing at all. That's fine. SPY is there waiting for you guys, right? SPY or some of these other ETFs are there waiting for you, right? Just do a little every pay cycle and you're good to go. Or you're like, I always have a few students every semester and they're like, oh, wow, I'm freaking all in, right? This is cool. I want to do this. All right, for you guys, just stay the course in data analytics, preferably in a financial space, right? And from there, you guys can make the jump. As long as you guys get into a data analytics role in any kind of financial capacity, right? Even if you go to E&Y or one of these guys, as long as you're doing data analytics in some sort of security class or something along those lines, after your 2-3 years, you can make the jump to some sort of investment fund because you'll have that skill set, crunching the numbers. If you develop that skill set, crunching these numbers even if you're not trading, right, or you're working for a trading fund, like you can work for Bloomberg, but as long as you have the experience crunching the analytics in a certain asset class space, eventually you can move to a hedge fund or investment fund that trades in that asset class space, and then you are an asset to that company because you know how to run the data, the numbers, the programs, all that jazz in that asset class, and from there your trading or investment career can take off. All right. Either way, hope you guys enjoyed the video. Hope you guys enjoyed this little lab. And I hope this is for most of you, for every one of you, this should be the beginning of you guys constantly investing. And for some of you, this should be a beginning for your stage and career in this space. All right. All right. Thank you guys. I'll see you guys at the next Q&A session. All right. Have a good day.